Real estate investments offer the potential to deliver steady, consistent returns. They can also offer a hedge against inflation. Stocks can be a great way to diversify your portfolio, and it doesn't require the same amount of capital to invest in stocks. Stocks come with volatility, however. They are susceptible to factors like investor sentiment and world events. Investing in real estate. Investing in real estate is one of the most popular options for wealth building. It offers a range of benefits, including cash flow, appreciation, and leverage. It also serves as a hedge against inflation and market fluctuations. It is also a tangible asset that can be passed down to future generations. However, it is important to understand the risks and rewards of this type of investment. Investors can invest in individual properties or syndicated property funds, which are mutual funds that hold investments in various properties. These investments can generate a higher return than stocks, but the risk of loss is greater. In addition, investing in individual properties requires a lot of time and knowledge to make good decisions. This is why many people prefer to invest in stocks through brokers who do the research and stock picking for them. Real estate investing is a great option for investors who want to create multi-generational wealth. It is easy to pass down property ownership through a trust and avoid paying capital gains taxes on the sale of the property. Additionally, real estate owners can depreciate the property and receive a tax deduction for up to 20% of the cost. Another benefit of real estate investing is its diversification potential. Unlike stocks, which are highly liquid and can be sold quickly, real estate provides steady income through rental payments. Moreover, real estate can serve as a hedge against inflation and market fluctuations. It is also possible to diversify your portfolio by investing in real estate through a fund or ETF. These investments offer a diversified portfolio of properties and are generally less expensive than purchasing individual properties. When comparing real estate to stocks, it is important to consider the total cost of ownership. This includes maintenance, insurance, taxes, and loan payments. In addition, investors must be aware of the possibility of vacancy and unexpected repairs. Fortunately, this can be mitigated by performing due diligence and hiring a professional property management company. Additionally, it is important to note that real estate investors are typically required to put down a large down payment and borrow money to finance their purchase. This can reduce returns when compared to a 100% equity investment in a stock. Investing in stocks. If you're interested in growing your wealth, you have many options. Some people invest in real estate while others choose to buy shares of publicly traded companies. While both strategies can generate strong returns over time, each has its own unique benefits and drawbacks. Consider your financial goals and risk tolerance to decide which is right for you. Investors who buy stock can generally do so with a smaller initial investment than investors who purchase property. You can typically buy a share of a company or mutual fund for as little as $1 to $5, depending on the brokerage you use and whether you're buying or selling on margin. Real estate investments require a larger initial capitalization since you're buying an entire property or multiple properties. The long-term track record of the stock market shows that stocks earn more over time than does real estate, especially when adjusting for inflation. However, you should keep in mind that the stock market can be more volatile than real estate. A big dip in the market can cause significant losses. In addition to earning capital gains, some stocks also pay out dividends. These dividends are considered income and must be reported on your tax return. The amount of income you receive from stock dividends can vary, depending on the company and the current share price. Both real estate and stocks can offer solid returns, but which one is better for you? The answer depends on a number of factors, including your level of risk tolerance and how much time you want to dedicate to managing your assets. Real estate can provide a steady source of passive income through rents, while stock market investing can offer more potential for growth. The biggest difference between real estate and stock investments is that real estate is a tangible asset, while stocks are not. This means that real estate has the ability to increase in value over the long term, while stocks can decline in value in the short term. This volatility can be unnerving for some investors, but it's important to remember that the overall market tends to gain in value over time. Investing in mutual funds. Stocks require less upfront capital than real estate investments. Individual stocks and mutual funds can be purchased for a fraction of the cost it takes to purchase real property, depending on the brokerage firm you use and whether or not you are trading on margin. In addition, resale of a mutual fund or share in an individual stock is much easier than selling a house. Investing in real estate also requires more work than investing in stocks. A person who buys real estate as an investment must be willing to spend time and money maintaining properties, especially rental properties. Moreover, purchasing a property typically requires a large upfront investment, which can be difficult for some people to achieve without using credit or other sources of debt. And even if an investor is able to save enough money to purchase a property, it may be better for them to invest in mutual funds instead of buying real estate, as the returns are generally higher with the latter option. Investors can often avoid the headaches of owning and managing a rental property by investing in a professionally managed fund that offers a diverse portfolio of companies and sectors. Additionally, the expense ratios of many funds are significantly lower than those of real estate. It is important to note that the average return for a stock portfolio is around 10% a year, while the return on real estate is closer to 4–8%. This is largely due to the fact that stocks have historically experienced faster growth than real estate. However, a person should consider the costs associated with both types of investments before making a decision. For example, real estate investors must factor in the cost of maintenance and repairs, insurance, mortgage interest, and property taxes. These costs can easily add up and reduce the overall return. Similarly, stock investors should consider the trading fees and expense ratios of their chosen funds before making a purchase. For a high-income professional who is able to trade his or her time for money at an extremely lucrative rate, the passivity of stock investing can be attractive. However, for the average person, real estate can be a more attractive alternative that provides a higher cash-on-cash return. Investing in ETFs. ETFs are an excellent way to build a diversified portfolio. They allow you to invest in traditional asset classes like stocks and bonds, as well as sector-specific investments such as real estate or tech stocks. They can also be used to diversify within an asset class, such as by investing in both growth and value stocks. ETF investments are very easy to make. Investors can purchase shares of an ETF using a brokerage account, and they can choose to buy them either on the open market or through a program like Edward Jones ETF Direct. You can place a market or limit order to purchase the shares that you want, and you can designate how many or how few dollars you wish to spend. You can also purchase fractional shares, making them a good choice for smaller investors. The returns on ETFs can be more volatile than those of real estate, but they offer the benefit of lower transaction costs and greater liquidity. Moreover, many ETFs include a wide range of industry sectors and asset classes, which can help you reach your investment goals. However, ETFs can also expose you to a single sector, which can increase your risk. While there are benefits to investing in both real estate and stock markets, you should consider your personal preferences and investment horizon. If you are planning for retirement, you may prefer the steady cash flow that real estate investments provide. Alternatively, you may be more interested in the growth potential of stocks. When choosing an ETF, you should carefully evaluate the investment objectives and risks of each fund before making a decision. A financial professional can help you determine which investments are best suited to your goals and risk tolerance. A prospectus is available for each ETF, and it contains important information about the fund's investment objectives, risks, charges, and expenses. Please review the prospectus carefully before investing. You can find a prospectus by visiting an Edward Jones branch or by calling us. You can also visit our website for more information.